There is a rule in investing and portfolio management that every investor should learn on day one. Rule 72. It gives you the number of years it takes to double your portfolio at your average rate of return. If you make an average of 3% return annually in the stock market, doubling your money takes about 24 years. You get the 24 years by dividing 72 by 3%. The 3% return is the average annual return of retail investors like you and me, according to many studies that have calculated the average return of retail investors over several decades. Ouch! 3%, 24 years. How can you double your money faster than other individual investors? Today I will share 3 ways to double your portfolio faster than the market average. Let's talk about that. I am Hoda Mehr, founder and CEO of StockCard, a fintech startup out of California that enables you to do your stock market fundamental analysis easier and faster. On this show, I share detailed fundamental analysis and fascinating investing-related stories. If you are new here, join the community by subscribing. Let's talk about 3 ways you can double your portfolio faster. Before we even start the video, I give you 1 strategy you can adopt today and reduce your time to double the money from 24 years to 7. Invest all of your money in the S&P 500 index ETF, ticker SPY. This ETF has returned an average of 10% in the last 30 years. 72 divided by 10 is about 7 years. Voila! But if 7 years is still too long, watch the rest of the video. Logically, you need to generate higher return to double your investment faster. That's simple to understand. But how do you increase your rate of return without gambling? That's the question. I can take my $100 to Vegas tomorrow, put it on the blackjack table, and try to double it in 5 minutes. Many investors try to achieve similar results by investing in crazy, highly volatile stocks, IPOs, and things like that. Those are possible ways to go about it, but they require lady luck to be with you, and many of us don't have the stomach to put our portfolio at risk and in the hands of game of chance. We want to discuss logical and practical ways we can implement quickly to double our portfolios faster. I found 3 strategies we can follow to achieve that goal, and implementing each strategy doesn't take too long and anyone, even beginners, can do it. I ordered the strategies from the most to the least common approaches, so as we talk about each strategy, it gets more interesting. The first strategy is to invest more frequently. Investing as soon as possible and frequently as possible is one of the best ways to double your portfolio faster. This is because investing sooner gives you more time in the market, and investing more frequently allows you to take advantage of the market's downtrend and lower prices, resulting in higher returns in the same time period. Most people don't do that because they want to wait and find the lowest market prices. It's logical, but in practice, it is almost impossible to figure out when the prices are at their lowest in the stock market. If you invest frequently without trying to find the so-called market bottom, you inevitably catch the market's bottom and invest at the lowest prices. I've seen this in our users' portfolios on a StockCard. In an attempt to find the market's bottom, most investors wait too long and the market goes back up before they take any action. Here's a real example. Let's say 2 years ago in September 2021, when the market got too expensive, you decided to monitor the S&P 500 ETF price with the aim of finding the market's bottom. You could have waited until April 2022 and the price would have dropped by 10%. This could have been the bottom and you could have invested all of your money at that point. The problem is that even though the market went up slightly after that point, had you waited a few more months, by September 2022, the ETF price was down another 13%. In reality, none of us can predict the exact bottom, and in an attempt to find the bottom, we either jump way too soon or stay away too long, missing the market's best days by waiting for a bigger drop. Instead, you would have been in a much better position had you invested your $100 slowly and a small amount every month between then and now and caught the market's bottom automatically by the nature of your frequent investments. This strategy is called dollar cost averaging and results in a smoother, less volatile, effortless strategy that can also improve your rate of return, especially if you are one of those investors who tend to stay away from the market for too long. Because of its effortlessness, it's ideal for beginner investors too. The second strategy is to take more calculated risks. This means investing in assets that have the potential to generate higher returns even if they come with more risks. But the risk is calculated and you still manage your risk by eliminating easy to see sources of risk. Rule 72 tells us that if our return is 10%, we need about 7 years to double our money. A 10% return is what most good investors expect from investing in low-risk, broad market indices before any fees and costs based on historical data. What if we get 1% higher? 72 divided by 11% equals 6.5 years required to double. How about 15% annual return? The time to double our money is cut to 4.5 years. Which assets have a higher annualized return than the broad market index ETF without taking too much risk? Well, of course, riskier assets such as small cap stocks, international emerging countries, and specific high growth sectors such as biotech and tech can give you higher return than the market's average 10%. For example, Vanguard S&P Small Cap 600 ETF, ticker VIOO, has had roughly 12% annualized return since its inception over 13 years ago, versus the 10% annualized return of S&P 500 ETF, ticker SPY. Similarly, Van Neck Biotech ETF, ticker BBH, has had a 14.3% annualized return since its inception 12 years ago. The problem with these investments is that they are also more volatile. Looking at their recent performance, many small cap or specialized ETFs have underperformed the overall market. You can easily get caught up in a down cycle and your return gets even smaller than the market index in the short term. But what did we discuss in strategy number 1 just a minute ago? Invest slowly and frequently as the prices go down. It results in higher overall returns. These strategies are not isolated, they are actually interconnected. We still have one more strategy to discuss that you can apply to your portfolio to double your money faster. But before that, I want to show you a very practical way to find ETFs with higher return than the S&P 500 ETF. I use our company's ETF screener tool to show you how you can use the stock card, of course, or any other tool you like. On the ETF screener page, I scroll to the return filter and choose the one with an all-time return higher than SPY. Just this filter alone reduces the number of ETFs from thousands to about 400. But not every ETF with an all-time return higher than SPY is worth our investments. What if the ETF has been around only for a year and happened to beat the SPY in that short time period due to market cycles or even luck? We want to narrow our search to ETFs that have been around for at least a decade, bringing down the number of qualified ETF for this screener to about 130. Now that we're at it, why do we have to pay exuberant fees to a fund manager if we can find low-fee ETFs that have been around for more than a decade and have outperformed the S&P 500? Well, let's add that filter, and that brings the result to about 90 ETFs. Going through this list of ETFs, you can clearly see what we discussed earlier. A small cap, mid cap, biotech, and even cryptocurrency focused ETFs are the ones that have had a history of overperforming SPY. I saved this screener and leave a link in the show notes if you want to continue your research and narrow down the results further. Go to stockcard.io and try it for yourself for free. Now, let's return to the last strategy you can apply to your portfolio to double your money faster. The third strategy is to develop emotional control. Improving your emotional control is typically advice from your school counselor or marriage therapist. I'm not either of those, but controlling your fear and your anger in response to the market's ups and downs is the most important skill you can develop, allowing you to double your money faster. Let's talk about a very practical example. We all have heard of buy low, sell high motto. Look at your own behavior. How many investments have you made in the last 12 months when the market is relatively lower than the all-time highs of the COVID rally in 2020 and 2021? Be honest. Were you buying things when they were high, hoping to sell higher? And have you stopped investing now because you are scared of the prices going further down? What happened to the old wisdom of buy low and sell high? Looking at the retail investors' trading volume when the stock market goes down confirms that we all make the mistake of doing precisely the opposite of buying low and selling high. During COVID's market rally, retail investors' trade volume was going up, and as soon as the market got a bit cheaper, the volume died down. Fear of losing more money and being scared when the market is down is a natural human reaction, but it's the enemy of your portfolio. Peter Lynch puts it best. In investing, your stomach is more important than your brain. In the $100 example I gave earlier, we discussed how investing slowly and steadily instead of trying to find the bottom can improve your return. In the same example, if you could have controlled your emotions and invested more whenever the stock market dropped by 10% or more, let's say in April 2021 and June 2022, you could have increased your investment return significantly. The more the market is down, buy more. This is not to say that you must wait for the market to dip. This means you can increase your return if you increase your investment when the market is down, contrary to the emotional reaction our brains may have in such situations. Dan Ariely, professor of behavioral economics at Duke University, gives one practical exercise that can help you and I strengthen our emotional control in investing. He advises investors to invest looking forward and assume they have no portfolio. Make investment decisions regardless of what happened to your portfolio so far. This means don't look at your portfolio when you want to invest again. Don't ask yourself, what do I do now that my portfolio is down 20%? Assume you have no portfolio, so the anger and pain of losing money don't cloud your judgment. Do your research looking forward, not based on what you have lost in the past. Today we discussed 3 ways you can double your portfolio faster. Invest as soon as possible and more frequently as possible. Take more calculated risks and invest in your own emotional control. Talking about these 3 strategies reminded me of another episode I published about 6 or 7 months ago discussing the 5 investing myths we should avoid to stop ruining our portfolios. That's a good episode that goes very well with today's discussion. Link is in the show notes. I'll see you next time.